Welcome, and thank you for joining us for today's webinar, Succession Planning for Business Owners, Know Your Options and Take Your Next Step. I'm Dennis Bialkowski, Executive Vice President of Private Wealth here at Hub International, and we've got a lot to cover today. There's a ton happening in the succession planning and wealth world, and we want to make sure you're ready for it. Before we jump in, a few quick housekeeping items. If you have questions as we go, drop them in the chat box. We'll get to as many as we can during today's session. We're also recording this, so if you want to revisit any topics we discussed or would like to share with your team later, we'll send everyone the replay link tomorrow. At the end of our discussion, a short survey will appear. It only takes a moment to fill out, and your feedback helps us shape future conversations that deliver the guidance and clarity you expect from Hub and all of us. I'm so excited to have our group here today. Joining me today is Robert Wermuth and Matt Culp. Rob brings nearly 30 years of financial services experience, specializing in corporate succession planning, estate planning, and family foundation management. Also, Matt Culp spent over 2 decades helping business owners prepare for a future transition. Matt's work is rooted in practical experience and a deep understanding of the challenges business owners face. Rob and Matt, as well as myself, we've been through the business succession before personally. And so our goal here is really to just kind of share what we've learned from working with business owners going through succession planning, as well as what we went through personally. So that way you have real life experiences and case studies. So here's what we're going to cover today. We'll start with the fundamentals of succession planning, including the process, tools, taxes, and techniques, then walk through your options as a business owner, and close with concrete action steps you can take today. That being said, Matt, why don't you kick us off with the succession planning process? What does it look like? What business owners should be thinking about? And where most people tend to start?
Thank you, Dennis. Appreciate your kind words and introduction. I think first we want to frame out, what do we know that most business owners want? And what we know is that, first off, business owners want financial independence. Financial independence outside of the business. They want to be able to help their kids, grandkids, and future generations. They also want to make sure that they're continuing to help the charities that they love. And last but not least, is that they want to reduce income taxes, capital gains taxes, and estate taxes where at all possible. These 3 points, Dennis, are really, really important, because when we can nail down these 3 points, this helps business owners to identify the best succession option for the future. But what we need to understand, though, as business owners, is that the odds are against us. And what I mean by that is, believe it or not, and this is a statistics from the Exit Planning Institute, is that only 20% or 2 out of 10 business owners who take their business to market transition on their terms. So 2 out of 10, that's a crazy low number. So what does it mean to transition on your terms? We'll tackle that a little bit later, but essentially means they're giving up something and transitioning out on someone else's terms versus their own. So why might that be? Well, first off is that 50% of all business transitions happen because of one of the 5 Ds: death, disability, divorce, disagreement, distress. So 1 out of every 2 businesses are transitioning stock because of one of those 5 Ds. That's a crazy high number. Last but not least, we find that 94% of owners haven't written a plan for their next chapter. So why is this important? As we'll dig into a few more statistics later, we'll share that 75% of business owners, 1 year after selling their business, regret it, which is a big, I would say, a mindset issue versus a money issue, and not planning of what that next chapter of life is going to look like. So our belief is that this is an opportunity to help business owners prepare for a future event that's going to happen regardless. It's guaranteed. Every business owner is going to transition out of his or her business. So our belief is that this can be a process, not an event. We find that most business owners allow this to be an event, which is what drives this low statistic of 20% transitioning on their terms. So our process, we have a 4-step process on how we're helping business owners, and then on our next slide here, on how we help business owners. And I like to say this is like, we have 3 phases to this planning. This is phase 1, which is our first 4 steps, which is goal identification, first and foremost, we want to bring spouses together and understand what are important things that they have to do now, have to do later, want to do now, want to do later. Oftentimes we see the things that have to be done now are things like reviewing the estate because the business may have grown significantly and it's not really accounted for in their estate and could have adverse tax consequences. Have to later might be taking care of older generation, mom and dad. Want to now might be helping kids. Want to later might be a second or third home and whatever it might be, helping charity. But this gives us the surface level of what's really helping or driving the why for our business owners. And where we eventually want to take this step one is to start to help business owners slowly start to work their way out of the business so they're not what we call the hub and spoke, meaning that every decision's coming in and out of them for business decisions, that we're slowly pulling them out of the business and helping them starting to focus on the next chapter. Step two is preparing their financial blueprint. So essentially what we're doing is taking all the things that they told us they want to do and financially modeling that and showing them if you continue on the pace you're at today, here's what that looks like. Here's the net amount after taxes that you're going to need to get from your business, which is the wealth gap. Profit planning is essentially saying, hey, you have time between now and that future date to take dollars of profit and diversify outside of your business. We still want you to reinvest in the CapEx projects and continue to grow the business, but we want to try and diversify outside of that just one stock that you might hold in a private company. We also want to make sure that we're looking at the estate value both today, 10 years from now, 20 years from now, 30 years from now, to understand if there's any estate tax exposure, whether it's at the federal level and or the state level. Also to probate costs. And last but not least is the emergency management plan is to say, hey, if unfortunately that owner falls into that one of those 5Ds and can't be in the business, working the business, what's the plan of action the next day to make sure that that business operationally is continuing to run with its current people and what people need to come in to help temporarily. So that's not a buy sell. This is a different document. And then number three, this is honestly one of my favorite parts of this process, is obtaining a fair market value of the business. And this is really what we like to say a planning valuation, which is to understand what's a value of your business if we're looking at a strategic buyer versus a family buying the business. Those are two very different values. And how are they going to line up with step two of your financial blueprint? Where are there value gaps within your business? Value gaps are areas where if we can close gaps, it will inherently increase the value of your business. Sometimes that could be upgrading your financial reporting. Sometimes that might mean that you may need leadership depth. So let's understand if that's holding your business back. That might mean that your customer concentration might be too high, meaning you may have a few clients that have a high concentration level of your revenue. That can be risky to a potential buyer. We also want to make sure we're helping the client understand what does the universe of buyers look like in their specific industry. So really trying to drive knowledge and understanding about what that looks like. Not to say that's what they're going to do, but information helps us to understand the things that we don't know and help us to get educated around what that future event's going to look like. And step four of our process is to bring the team together. I like to say, if we're going to get ready to play the Super Bowl together, we want to make sure that we have a lot of experience working together and collaborating with the CPA, right? If we want to reduce taxes as much as possible and cap gains and ordinary income in a state, hey, we got to make sure that we're talking with the CPA and driving goals and driving strategy and implementing it. Same with the estate planning attorney. If wills haven't been reviewed in years, we want to make sure that they're understanding where there's gaps lie in the estate documents to coordinate with the estate attorney and the business attorney as well with buy-sell agreements. So we want to make sure that this coordination is happening years in advance of there ever being a transition, whether that business is transitioning to family or whether that's positioning to a management buyout or an outside buyer. So again, this is phase one. Phase two is where we're identifying and evaluating in step one and saying, all right, here's what our action steps are and step 2 in implementing those action steps. And then phase 3 is coming back to the business owner after a period of time of completing these projects and understanding, all right, are you going to keep the business, or are you going to start to sell or transition the business? So let's dig into a case study, please. So I want to talk about our client we worked with for over 18 years, and this was a G2 ownership, but it's important to understand how this G2 came about. This was actually because of one of the 5 Ds. The father had not did not have a formal succession plan. The son had just started working in the business, the business development side of things, and unfortunately, the father passed away prematurely. And this was back in early 2000s when the estate tax gifting was a lot lower, and it was a mandatory valuation for estate tax purposes that had to be completed. And the long story short of this is that this G2 son ended up paying estate taxes because of the value of the business, which at that time was valued about $2 million, plus other estate items. And then he also, in the way the father had the business positioned in his estate, is that he and his sister split the business 50-50. Well, his sister didn't want to be in the business, so on top of paying estate taxes, he also bought her out as well. So, at that point in time, I don't want to say it looked bleak, but man, he sure had a lot going against him. But I also too believe that he learned a lot in that process of eventually when he transitioned the business, he already had a future vision of what that looked like and what he didn't want. And one of those big items was owner independence. He wanted to make sure that over time he was building a business that could run without him. And this is a key piece on the collaboration with advisors of why this is so important to have your advisory team working together, is that the way we worked with the CPA, we worked with the attorney, we worked together as a collaborative team for the goals of the client. And essentially we're sharing this information so the left hand knew what the right hand was doing. And the coach he hired, which I would strongly recommend this book, E-Myth, which talks about how to develop owner independence outside of the business. And essentially what this owner did is he knew what his financial picture looked like because we were running the financial blueprint for him. So he knew where he stood, and we were plugging in his business value, which every few years we were updating that range of values business valuation, making sure that his shareholders agreement were up to place, making sure that his insurances were at appropriate levels as the business grew in value. And essentially over time, I still remember to this day the conversation we had with that owner, because he knew what he needed from the business to do everything that he wanted to do for the future, and having that range of values. And the range of values far exceeded what he needed to do everything he wanted to do in his life, like far exceeded. And our question to him is continuing to grow this business, is it worth it for you? And we didn't mean that negatively, but the larger that business gets, the more risk he's running. And at some point, it's a matter of how do you want to move forward with the business? The long story here is that he took care of his people. He took care of his financial independence. Over time, he became owner independent, meaning he was building up a management and leadership team where he didn't have to be in the business each and every day, which grew his value. It allowed him to eventually focus on the best fit buyer, which he still serves on that board today. So
Matt, I've got a question from the audience here, if you don't mind.
Yep.
You mentioned that he was able to take care of his people and his key people and stuff. How did your client incentivize or retain key people? And do you find that if you've identified key people, does that actually make the value of the business more attractive to a buyer?
That's a great question. Great question from the audience. So first, he did have low employee turnover. And I would say that as most of that employee growth was organic. And essentially what he did a great job at with his business coach, the E-Myth coach, was understanding strengths and weaknesses of his employees and putting them in roles where they were naturally going to succeed based upon their strength. They still had to show up and put forth the effort, but he provided the career path for their growth up to the point where they were running the business at the highest level which allowed him to create that owner independence. So how did he keep them? Well, he incentivized them. First, he paid them well with salary. Second, performance bonuses, which occurred year in and year out. So as the business succeeded financially, so did the key people. And I do want to mention that he did not share stock. Oftentimes, we find owners want to share a piece of the business. And in most cases, what we find is key people really want access to money. They don't want a minority share of the business. So the way he structured the third piece of their compensation was a long-term incentive plan that eventually those key people benefited from that incentive plan when he sold the business. But then he also, when he drove the value from 2 million to 30 million over that 18-year time frame, he also shared proceeds of the business with those key people, actually the entire company, but especially that key management team, which afforded them the opportunity to use some of those proceeds to buy into the new business. So it's a phenomenal story. I just want to also just mention that time frame, that 2 million to 30 million over 18 years, that is an average rate of return of 15% compounded and does not include the rate of distribution, meaning income or profit distributions that he was taking from the business. So lastly, why do people stay? They had no reason to leave. He continued to upgrade them in their positions. He gave them the opportunity to grow, which also means taking on challenges head first, and he communicated with them and he incentivized them.
It's great. That's a great case study, Matt. Well, Matt, thanks. I appreciate that background, and that case study was fantastic. I want to share with you today is, as Matt said, it's really important to have a formal blueprint, to have your plans memorialized, and to keep the end in mind. To start, you need to know what the estimated value of your business is today, as Matt said in his process. And of that value today, what would you get to keep if you were to transition your business after you supported your key people, you paid for the expenses associated with doing that transaction, and then the taxes? It's really complicated, and it takes strategy, and it takes tax strategy. Today, I'm going to share with you some basic, education on taxes and how to plan for the taxes and how to plan around them when you can. Some of the tools you can use, like in the year before a transaction, during and after a transaction, to better support the outcome and the after-tax outcome for you and for your family and for the generations and maybe trusts. And then how trusts can be used to improve that outcome significantly as it relates to estate taxes. So let's dig into these three issues, and then I'm going to share with you 5 succession planning options and some of the basic characteristics and some of the concerns around them. So the basics here with taxes is that we have to recognize is that taxes, we'll go to the, next slide. Taxes is that buyers want to pay with after-tax dollars. And so if you're a buyer and you have to pay with after-tax dollars, if that's your child or a key person, those people have to come up with money after tax, and oftentimes they don't have it, especially with today's business values in the tens or hundreds of millions of dollars. So stock sales, there's 2 ways you transition your business, either a stock sale or an asset sale. In a stock sale, you're selling your stock in your company to another. And for you, the seller, it's taxed at capital gains. For the buyer, they don't get to depreciate that purchase price, and they assume your tail liabilities. So you've been in business for 20 years, they accept all of those liabilities. There's ways to insure them, but it's still, in a buyer's perspective, they don't want to buy liabilities and they want to depreciate. So buyers would rather buy your assets. So if I sell my assets, it's generally taxed to me at ordinary income. I might get long-term capital gains treatment for the goodwill built up in my business. Well, right there, I need to understand how I could structure my business transition in an asset sale more attractive to the buyer pool and what my taxes are going to be. And maybe I'd accept a little bit more in a sale price if I'm going to pay a couple more dollars in the taxes, but it needs some pre-planning. Remember, when buyers buy assets, they get to depreciate, and there's no tail liabilities that they're accepting. buyers don't want your liabilities. So buyers always want to buy assets where they can, and sellers want to sell stock. We need to dig into that early on so you understand how much of those transaction proceeds you're going to get to keep. On the next slide, we talk about estate
Hey, Rob,
taxes.
real quick, sorry
Sure.
to break in. We had a question come in on what happens most often, asset sales or stock sales? What's most prevalent?
I think asset sales, Matt, because buyers want asset sales. They just may, the actual purchase price may be some additive piece there, so the tax is equal for the seller. So taxes and business succession. In the estate tax world, we have to recognize right now that each of us have a $15 million federal estate tax credit. And I can give away my $15 million during my lifetime or at death, and so can my wife. So if we have a $130 million estate and we have a $30 million credit, my wife and I both pass, the first 30 go and there's no estate tax. The next 100 is taxed at 40 cents in the dollar. That's the estate tax rate. That'd be $40 million due 9 months from the date of death. Now, if I'm a business owner today and my wife and I pass and the taxes are due 9 months from the date of death, maybe that $130 million value is tied up in the business. Well, that's going to create some waves at the business and some concern as to how the business is going to support that $40 million tax that's due, when really it's in bricks and mortar and people and payroll and bank covenants and all of those types of things. It's a concern, and it takes planning and a lot of pre-planning. Remember that $15 million for myself and for my wife, the $30 million is a federal rule. We just still have some state rates in there that are additive. And that $30 million is indexed annually. There is some thought out there, if you read a lot about this, that that tax rate at 40% is pretty low in history, and that could increase over time. And it's really important to remember you can use this during your lifetime or at death. So remember, both income taxes and estate taxes, you need to understand, have some basic education and have the right advice around it well in advance of doing a transition for your business. On the next slide, we're going to talk about some of the tools associated with business succession planning. And these may or may not apply to you, but it's important to have in your back pocket. So the first is stock recapitalization. It's really separating both the voting stock from the non-voting stock. Just take the same value of your company and you separate the vote into one share and then the value into all the other shares, the other 99%. So I would like to keep that voting share in my pocket now and as long as possible because I want control, like what Sam Walton did with Walmart. But with the non-voting shares, I might be more willing to gift or to sell them to trust or to my team or to my family during my lifetime, as long as I get to control. So recapitalization doesn't cost much. It's a pretty easy thing to do. And it's an important tool to understand. Again, may or may not apply to you. Qualified plans as a tool really doesn't fit many situations, but it's important to understand. I have a situation right now with a contractor in Maryland, and the contractor has 20 people on their payroll, but they have hundreds that are union employees. Well, the union employees have their own retirement plans, so we really only have 20 people on this pot. It's a very rich company. Mom and dad are both active in the company. Actually, mom owns over 50% of it. And we're now doing a study to put a qualified plan in place called a cash balance. So really it's combining a 401k, traditional retirement plan, safe harbor, profit sharing, and cash balance, stacking one on top of the other. And we're actually doing it back for the year 2025, which you can do as long as you extend your tax returns for this year. So we're doing it for last year and for this year and the years in the future. And in this situation, mom and dad get to take their $70,000 or so pre-tax out of the company through what the old plans would be, stacking the other plans to get them closer to $700,000. Well, it's a great way to take money out of the business on a before tax basis. They'll do that for 6 or 7 or 8 years plus growth. It's a great way for them to start to build some of their own capital outside of the business because they want this business to be worth less in the future so they can transition it to their kids in favorable terms. It's a good tool to understand. It's a little technical. We understand it. and we can help model that if it has a fit for you. The fourth tool is distribution planning. Many times that's used when you sell some of your stock to a key person, or you sell it to a family member, and you take a note back. I sell 10 million of my stock to my 2 kids. I take a note back for 5 and 5. And how do they pay for that note is now they're eligible for distributions when the company makes or distributes profits at year end. They take it, they tax it, and they make a payment on their note. We'll talk a bit about that more in a minute. And then stock discounting for gifts. In the stock discounting, the IRS allows someone to get a valuation on their business and value 1 share of stock, and then also value it for a minority share for discounts associated with lack of marketability and lack of control. So if I have a $100 million company and I value that company today, on the street it's worth 100, but when I get a formal valuation, it's worth 70. And I take $10 million of that stock, write a minority interest, and I put it into a trust for my kids today under that $30 million window. That may not cost me 10 million of my 30, because the IRS is going to say the value of that stock gift might be closer to 7 million, because they're going to discount that value of the gift today because it's not marketable. In the trust, it's not marketable or saleable, and the kids can't control it. They're a minority shareholder. So I get to squeeze more stock through the use of discounting and gifting today. And then I get to remove the growth of that stock out of my estate, much more importantly than just the discounting. It's kind of twofold. So when the tools to
We
understand,
got a question from the audience, Rob, real quick, if it's okay. You're describing very complex different strategies on how you could exit or partially liquidate some of the business, the estate structure, the tax structure. That's something, there's a lot of people that are needed on the team. And someone asked, how do you determine who should be on the team as far as helping a business owner transition? And how do you find people that can give you these ideas and these options, not just give you one exit strategy, but multiple?
Dennis, I think that in the old days, what you had is a client who went to their estate attorney, and then they went to their business attorney, and then they went to their accountant, and they tried to decipher all that information on their own. And in today's values that are worth tens or hundreds of millions of dollars, it's much more complex. So first, go back to what Matt said, keep the end in mind. If you're worth 100 today, you'll be worth $200 million tomorrow. I want to put together a $200 million team. And I want to use a Dennis, a Matt, or a Rob to be that team quarterback and bring that team together. On Monday, I had one of these types of meetings. I took the client, their accountants, and the estate attorneys into a room physically, not Zoom, 2.5 hours. And we talked about their 5-year strategy on their both transition and their estate tax plan. And we left that room with some great ideas because we actually dug into the detail. And honestly, no one person came up with all the best ideas. It just takes time and attention, but you need a team member to organize that. And again, back to what Matt said, keep the end in mind. If you're worth $50 million today, then you really need a $100 million team. Are the people at the table really $100 million advisors? So thanks. That's a good question. Thank you. Okay, on the next slide, remember we talked about taxes, tools, and trusts. So in the trusts, some of the benefits of trust. Now, this is a very confusing word. There's many different types of trusts. But generally, the menu looks the same regardless of where you're shopping. They are technical, and it's important to understand how these work in concert with what you already have on your kitchen table, and have a model to show you what these look like over time together, both on and off your kitchen table. So one use of the trust is to grow your stock outside of your estate. If I could gift 40 million of stock through that $30 million window and grow it in years to over many years, I can double that and double that again without that 40% estate tax. That's great. I might use trust to equalize active and inactive family members. That's a bit more complex. We just have to remember that many families have some children or their spouses that are active and some that aren't. And trust might be one technique we might have in our back pocket to help support the family members that are not active. And then I have a couple of companies over the last decade that are just true cash cows that should be around for generations. and they've separated the ownership and trust, so they don't have the estate tax concern with the management of those companies at the family at the kitchen table. So trusts are technical. Trusts are really both a control and a tax planning issue, and no two are alike. But it's really important to understand, with your balance sheet in one hand and the trust grid in the other, what your family situation looks like and what we're going to leave it with in our kids' hands. Okay, so on the next slide, I'm going to just talk quickly about a case study, and I'll try to keep this simple. Back in 2020, I have a manufacturer out of state. I've known them for a long time. They have some secret sauce in what they do. They made about $2+ million after their general compensation and all their benefits and some other things through the company for years and years. They had great balance in their life, 60 years old, excuse me, and a really diversified balance sheet to begin with, because they had so much money coming out of the company. A couple pieces of real estate, both personal and investment. Real estate, and a private equity company gave them a call out of New York. They said, hey, look, we'd like to come and visit with you. And my client knew the company. They had purchased a couple of their buddies or similar companies, and they knew where they were coming. So they entertained the conversation. The New York group came down and visited with my client. My client and his team went up to New York and visited with the PE group. They shared numbers, and 60 days later, he has a formal letter of intent. And I mean, one of the cleanest cash-only letter of intents I've ever seen. Low debt. It was really great. Everything about this looked as squeaky clean for my client. Not a lot of gray. So, but my client's 60 years old, and he thought long and hard of it about for a week. He talked to his friends and family. He came back and he said to me, look, I'm not going to do it for a couple of reasons. First off, I don't know who to turn to. My current accountant is great at doing my tax returns, but really not a deal accountant. My current attorney is great at doing real estate or contracts, but doesn't understand how to sell a business. And the third is that, what would he do with this money, and what would he do with his life? He'd be out of the business in 3 to 6 months. Like as Matt said, you need to be prepared for this and have a plan and do it in your own terms, in your own timeline, but have to have a written plan. So he said no. And by the way, the offer is $25 million, right? I was making $2 million of distributions with a 10 times multiple. Made great sense. So a week later, they came back and upped the offer to 30. He said no. A week later, they came back and took it to 35. They said no. Like, honestly, that's a great conversation, right? And they increased their offer by 40%. He still said no. So what we did was we went back and we built the team, and we found the right deal attorney, the right deal accountant. We had a good estate planner. We got that team together. We got prepared. We recapitalized the stock. We did gifting into trusts. And we started to build a model. And the team thought sometime in the future I'll get to the market. In 2023, the team and the client interviewed investment bankers that were industry specific. And he went to the market. He came back with multiple offers, and he sold the business for $50 million. He's still active today, as is his family member that was active in the business for many years. And the 25% that he retained is owned in trust with a private equity sponsor. It's really exciting. There'll be a second sale in the next handful of years. So this is a success story. They don't all look like success stories. All right, so the next area, so in the back pocket, I want you to have your tools, your techniques, and the trusts, right? You've got the right team by your side, and now you're thinking about what option would be right for you. And by the way, on the options, you really probably have a gut feeling already what path is going to be right, or maybe one you should be exploring, and what maybe your second option would be. So in our next slide, we're going to go over the 5 succession planning options. First, transitioning your business to key people. Second, transitioning to family. Third, to a strategic buyer. Fourth, a private equity buyer. By the way, the difference there is a strategic buyer probably does something like what you do. You know who they are. They're the behemoth in your industry, and they would do anything to get you, because their 1 and your 1 would equal 4. It's magic, right? They're generally the one where you get the biggest price. Private equity is a financial buyer, but generally not as juicy as a strategic. And then the last is transitioning your business to an ESOP or an employee stock ownership plan. So in the next slide, we're going to dig in first into transitioning your business to your key people. Next slide is when transitioning your business to your key people. What we want to remember is the biggest concerns are you're going to give up control to the people that have been reporting to you you've had control over for many years, and giving up control is really hard to do. But there's plenty of ways where you can retain control till some point in the future or some trigger, and just takes a team to kind of model that for you. The second is that oftentimes these key people can't afford that purchase price. Remember, they need to buy you with after-tax dollars. If your business is worth 2 or 3 or 5 or 10 million, maybe. But if it's 50 or 100, that's pretty problematic for key people to find that kind of money. And then the third is the age of the key people, because what we find is that, many of the business owners, when they're ready to transition, they're in their later 50s or 60s or even 70s, and their key people might be their same age or 10 years behind them. And therefore, I don't find many 50 and 60-year-olds that are willing to sign a note or debt or the bank terms at that age, take on that level of risk to be indebted for the next decade of their life till they're in the late 60s or 70s. So the age is a key player here. Earlier you start, the better. So tools in this situation is oftentimes, if, as Matt said, if I know what you're trying to accomplish as a family, we might sell this business or transition it at a discount to the key people, but get you what you want economically out of the business through qualified plans or through distributions or some sort of tail benefits. On the next slide, you'll see some considerations. Is that oftentimes these transitions happen in tranches. Okay, I'll do 49% now and 50% in the future, and the 1% vote at the very end. But then we go through a business cycle where there's 3 or 4 or 5 years that the distribution's not made to the key people, and therefore they can't afford to make their note payment. So that's a concern, because we haven't seen that for many years in most businesses, but traditionally it's going to come back again. The second is when we have key people, when there's a capital call, when things aren't good, we don't have the cash flow to make the note payment, and then the bank wants us to put money in the business just to keep it afloat, and they're not used to capital calls. So you get value to the owner or to the founder through salary continuations plans or cash balance retirement plans, or maybe some tail income at the end with benefits. And we just have to remember that there's a lot to consider, and you need a model. So transition to key people are really very common when our businesses are worth $2 and $3 and $5 million. But in nowadays, with today's values and the alternatives you have, it becomes less and less common. So on the next slide, we'll look at the succession path number 2, which is transitioning to your family, which is really what Dennis, Matt, and I do all the time. So in transitioning to your family, on our next slide, we can see the biggest concern again is how can they afford it, right? I mean, you want to transition to your family, you just can't give it to them. You can't give a $50 million business to your family without paying some gift taxes, right? So how do we do this? It takes a plan and strategy. And then we think about how do you treat inactive family members? So I want to take care of my son or daughter or their spouse that's active, but I want to be conscious and I want to be fair to my inactive. And there's this fairness and equal is a really tough conversation for most families. We've been through it hundreds of times, especially when their son or daughter or their spouses have taken 10 and 20 years and 30 years in building this business to this current value to afford me my lifestyle, when my other son or daughter is chasing their dreams. Should they be treated equally? I don't know. But there has to be a plan around it, and that plan includes not just dollars, but communication. And some of the tools we're going to use here where we can get really creative in this situation is, of course, discounting. I would rather make sure that my wife and I have enough of economics from the company to achieve all of our goals, but transition this business in the most favorable way for my children and for my family on a discounted basis. Oftentimes going to use trust. Oftentimes we might have some plan that's a qualified plan, or tagging on top of that some sort of distribution planning on further income from the company being given out to shareholders and then stock recapitalization, keeping the vote of the company, and the non-voting shares going to the trust or to the kids. So some of the
Hey, Rob, real quick, we have a question that just came in on the stock recapitalization, non-voting and voting with marketability discount, minority discount. The question here is, what's the typical discount that you see off of a stock price? Is there an average?
I think it's between 20 and 30, Matt. That's what I see. What do you see?
Yeah, I mean, we're working on a case now where 30% was the number that they were using for the discount.
Yeah. I think that's if you think about it, if you could shove $40 million of stock through the $30 million window and only use $30 million of your credit and not pay any estate tax, I mean, that's a great plan. So,
Yep.
Okay, on the next slide, some of the considerations when transitioning your business to your family would include that no two structures or plans or families are alike. It takes conversation and creativity from the accountants, from the estate and legal team, and from the team quarterback like Matt, Dennis, or myself. Second, we need to remember company earnings and distributions are oftentimes a part of this conversation, and they could fluctuate. And you need to model what if things go awry for a couple of years. Third is how important control is. The last thing we want is to put control in the wrong person's hands, or you think it's the right person, but they're not really developed. They haven't had the type of maybe day-to-day battles that you have had, because they're being handed something that looks pretty good from the get-go, but they're not ready. So there needs to be a development plan around that. There is a lot to do in family succession planning, which goes back to the family office services and governance and communication and successful communication with families and wealth. It's a lot of what we do for a living.
Hey, Rob, just a question for you. What's your insight on peer groups and business coaches for next generation development?
Oh, Matt, I see it over, and I know you do too, over and over again. It's critically important. It's important to have that plan. What we found, I have a recent, another partner and I have a case, a great business, printing money in construction. They're national, and they've got 3 active kids in the business. And when we walked in the door, there was actually no plan in place, and there was no, they were not treated like the others. Like the maternity leave or paternity leave was different for them than the others because of the last name. Like that just can't be that way, right? And so we're really trying to develop those kids. That they hired a coach and a consultant. They really work with both everyone as a mentor. The seniors have a mentor, the kids have a mentor, the people in the middle management have a mentor. Everyone has got a career path. It's really important to have that type of communication. And it's not treated like it's a negative, it's a positive. They've all leaned into it. We thought was going to be controversial ended up being like a great development plan for these kids. So yeah, I'm with you on that's super important. So on this consideration, it's best to model or scenario plan. So I'll go through the last in a couple minutes here. It's just that the next slide is on strategic buyers and private equity. What we want to think through here is in transition your business to a strategic or a private equity. Oftentimes it's a process. I'm going to combine those two together on the next slide and think through when you're going to transition your business here. You have to remember you're getting into business with a stranger. Those strangers are going to have a great deal of leverage. Read about that in the papers these days. And we need to understand how much leverage they're going to use to buy your business, because like your baby, you spent your lifetime doing this and may not end up well. These
Rob,
deals.
we have a question on this one. It actually came in earlier, but I wanted to wait till this segment. We went through a couple of different transactions without an investment banker, and then we did our big one with an investment banker. And I will say it was night and day difference and extremely valuable. We didn't know what we didn't know, being entrepreneurial focused. What do you see from should people get an investment banker? That was a question that was asked. And then how do you identify a good investment banker? What do you look for?
So for me, I think that it's imperative that you have one. It's just flat out imperative. but there's a lot of questions when having this team member come to your table. I generally already have my clients with their accountant, with a deal attorney, with their estate attorney, and we're going to take their advice and direction in interviewing and setting the criteria around hiring an investment banker. I want an industry specific investment banker that has done 2 or 3 or 4 deals in the last 2 years in my client space. If you manufacture boxes, they should understand about box manufacturing and manufacturing in general. I'm not going to go to a generalist. I'm not going to go to the guy from the club. I'm going to go to somebody that's from my industry, and I'm going to interview that person with the other advisors. I'm going to understand that the person I interview is the person that's going to be representing me from day one till the close, right? I want to understand who on their team is going to be the legal person that digs into these contracts and brings value to my clients through the actual agreements. It's not just the deal attorney on our side, it's also the investment banker and their team understanding in the middle how these deal terms are done. It's a critically important role, and it's not about getting the most dollars. It's about getting the right partner, right, and the right culture and the right terms around it, and not spending our life in court or with lawyers all day long. So, great question, though. I think that again, concerns or getting in bed with a stranger or getting into business with a stranger, the amount of leverage, the deal terms, the escrows and the earnouts, the escrows and earnouts, many people don't even know what those words mean. We need to dig into those early on. There's a great book. It's called The 17 Reasons Why My Business Is Not Investment Grade and like what to do about it. It's from an investment banker, Zane Terrence. If you want a copy, send us an email. We'll send you a copy. Some of the tools you might use here is discounting and trust. Of course, we're going to get a big number for our business. We want to get most of that out of our estate when we can, well in advance, not a month in advance, not when you have a letter of intent in your hand, a year, 2, 5 years in advance. And then we could think about how we would retain, like Matt said, retaining your key people. The next slide just goes over some of the considerations, which would be building that experienced team. I think we've talked about that. Other considerations today are the cost of debt has increased dramatically. It's not like it was 5 years ago. And so we need to be concerned about our business and the cash flow associated that's coming out of it now, having to support that debt in the future, because our buyer has to support that debt and they're doing it with our business. And then how that deal structure is going to be done at the end of the day. It's really litigious and it takes a team. Now, remember, in selling to a strategic or selling to private equity, it's where you're going to get your biggest number, right? That's the stories we hear all the time. Oh, they got a multiple of blank and but they have so much more than they expected. But there's always more to that conversation. And you're giving up a lot there, like control. So the fifth path I want to go over is employee stock ownership plans. So on the next slide, and one more, we'll see in the employee stock ownership plan, it's generally we're going to get the lowest dollar volume. In the employee stock ownership plan, what you're going to find here is that oftentimes it's I want a business owner wants to reward their people that built this business together. I find them very common in service industries. I find them very common in G2, G3, G4 businesses. It's when a business owner may want to take some of the money off the table, but still maintain control now and forever. I've used these to buy one partner out of a business 20 years ago. The value of the business was $20 million, and the one partner bought the other out for $10 million. The ESOP bought the shares, and then a little bit more to that story. But an employee stock ownership plan, the concerns are really the debt structure, because really you're financing it yourself and the bank's financing it. It's generally done with 100% debt. And most structures I've seen in the past, if it's a $40 million business and you're selling it to an ESOP, you personally may hold, or the owners may hold $20 million of that debt, the interest only for some period of time, like 5 years, and then pay down the principal and interest over the next 5. And during the first 5, you're paying back the bank. So you need to be able to support that. It's in a model. The magic of ESOPs come in 2 ways. First off, it's tax favored to the seller. If you're a C corp, the seller gets that 40 million bucks, and it's income tax free because you're still going to do an exchange property around that $40 million. It's like selling a piece of real estate into a 1031, right? The second is that when the business pays that $40 million, they pay it with before tax dollars, not after tax dollars. It makes it a lot easier for the business to make that payment. So it's modeling at the business and modeling at home, right? And so ESOP has some tax magic to it, but there's all, it's very dependent on the company's success. It is part of a qualified plan. And the last slide here is we to think about the debt structure and the self-funding. You're going to have an ESOP trustee on the board representing the employees and blessing decisions that were once yours. It's expensive, very expensive to model, to understand, have the ESOP consultancy, the legalities around it. And then last, it's very flexible. I've had business owners sell 25% of their business or 50 before they get to doing the totality. You can do it in steps. And the other piece is that if you sell half now, you could go back and do the private equity later, right? It would benefit the employees and your family. So they are a very flexible plan, but they're a lot to swallow.
Rob, you mentioned in Succession Path 1, key management buyout. And you mentioned that sometimes the challenge there can be that the purchase price can really be more than the key management team can afford. Have you seen a match where a percentage of the business is bought by key employees and then a percentage of the business or remainder of the business is bought by the ESOP?
Yeah, I see. I have seen that structure before. I have not used it personally, but I think that it's a very viable structure. At the end of the day, it's this ESOP, as Matt just said, those key employees could be a couple of your family members, right? And it could be a mix of non-family and family. So you can have your family still active in the business now and forever, which is part of your goal. It's we just need to understand what the goals are right from the get-go to see how you kind of combine some of these different structures. So when you think about the five, we go to the next slide, the 5 different plans together. A lot of times the issue is, hey, how much do I need or how much am I going to get? And that may dictate which path you choose. And the other one is about your ability to give up or retain control, right? So I think that most business owners could hang up this call and say, yeah, I really think that's probably my most likely path. I should explore and read more about that and understand some of those pitfalls and lean into that in my team building to begin. And then last, I'll just give you a quick example here is that on my next slide is that I have a family business where mom and dad were both active in this business. They're have a business worth about $60 million in the market, and their net worth is about $80 million in some personal real estate and some qualified savings, retirement plans. They have 3 kids, 2 active, 1's not active. They're in their early 60s. They have a great balance in their lifestyle. They're not beholden to this business 24 hours a day. They're in control, and they want to stay in control for the next 10 to 15 years till they're in their mid 70s or late 70s. So that sounds good for mom and dad, but for the 2 active kids, they would like to take control today if they could, right? So the team met and strategized over time. The business just keeps printing money. We thought about they would recapitalize their stock to begin with. Recapitalize was separating voting and non-voting. They did a valuation on that stock, and they made gifts of that stock, the non-voting stock, to trust for the 3 kids. The trusts receive distributions based on that amount of the stock in which they currently own. So the company distributes $1 million a year. 40% of that's going out to the trust because those trusts own 40% of the stock. And for the 2 active kids, they're going back and buying more stock from mom and dad. For the inactive child, they're using those monies for their lifestyle or to accumulate and invest in the trust, right? And then mom and dad in this situation have instituted some different types of plans where they will continue some benefits and accumulate some more benefit from the company, like the cash balance plan. And we model this from top to bottom every year with the tax team. And that's what, Dennis, Matt, and I do all day long, is model these different scenarios so a family can see what their current plans have done in the past or what new that's being proposed would look like, whether that's in transition or trust or sales or whatever the topic is that comes to your table. So just keep in mind the taxes, the tools, and the trust approaches, and the 5 different paths that you could choose, and then think through how you could build your team around that. All right, Matt, back to you.
Well, thank you first for your time here today. We hope that this has been a valuable use of your time, and we surely hope that they're thinking, wow, this is a lot. There's a lot to think about. What's my first step? So we have 3 opportunities to engage for the next step. Our first is to take your phone out, hit that QR code, and take our business owner readiness assessment. It will take you 5 minutes. It's 20 questions, and it breaks down the 5 critical areas for business succession planning: business readiness, personal readiness, mindset readiness, legal, and tax. So please take this. Once you take it, you will receive immediately an email with the results of your readiness assessment. Each category will be colored red, yellow, green, so you can start to see kind of how you stack up. And then we'd love to have a conversation with you to understand, where do we go from here? Pay it forward action item number 2 is our complimentary range of value analysis. So again, this is not a formal valuation. This isn't something that you can go put in front of a judge for gifting or estate purposes. Okay, this is a range of values to help you understand approximately where does your business fit in net worth wise or value wise, and how that might be used for planning assessment, whether you're wanting to plan for a future family business succession, or whether you want to position for private equity, to understand what your industry looks like specifically in as far as valuation is concerned. This will also help us identify your value gaps. So please hit that QR code, and we will be in touch to start that process and help you understand the documents that we're going to need in order to do that. And our third step is making sure that your legal documents for your business are in proper alignment. So that may look like your shareholder agreement or your buy-sell, your articles of incorporation. We will do a pay-it-forward free analysis of your business legal documents. We want to make sure that we're that alignment, that there's no gaps or things inside your documents that conflict with what your goals are. We sincerely appreciate your time today, and thank you for your time. I do also want to make sure there was a question that came in here briefly right here at the end on the buy-sell stuff. It said, how should the liquidity strategy look different when the exit is unplanned versus planned? That really does come for multiple owners, comes down to the shareholders agreement and what the buy-sell says on the buy-sell structure. We talked about the 5 Ds earlier: death, disability, disagreement, distress, and divorce in the business. All 5 of those need to be addressed in the shareholders agreement, and making sure that they're funded properly. For instance, with death, life insurance, most companies have grown over the last 5 years. We want to make sure that there's no gaps in that funding, and making sure that should a shareholder prematurely pass away, that there's plenty of capital in order to appropriately buy out that partner. Most times in partner business structures, oftentimes the spouse wants cash, and the spouse does not want to be in the business, and partners don't want necessarily the spouse in the business. So got to make sure that says it properly. For sole owners, if you don't have a key person that you might want to have a make up buy sell with, you got to make sure that your estate documents are in good order, and that you have plenty of personal life insurance to cover the event that you're not here. Also having key key employee insurance inside the business to make sure that the business can continue to fund itself, to bring in the key personnel to help continue to run that business while your surviving spouse figures out the next step. So thank you.
Thank you, guys. Rob, Matt, really, really do appreciate it. And thank you for breaking this all down. Thank you for giving real case studies, real examples, and also so many ideas to think about when you're going through this. Obviously, this is usually the most important decision people are making besides who they marry. But importantly, this one can have a big effect. So we really appreciate you guys kind of going through the different scenarios. And thanks to everyone who joined us. Before you go, you will see, just a reminder, a quick survey pop up. It's quick, just a few questions, and it helps us figure out what topics like this might matter most to you in the future sessions. It also where you can let us know if you'd like to talk with someone at Hub, and we're happy to follow up and answer any specific questions you have. Once again, thank you everyone for joining. Thank you, Rob and Matt. This was phenomenal.
Thank you.
Thanks, everyone.